Hello everyone, I'm Bob Bruce from Integrity Wealth Consulting with our July 2017 Educational Economic Update. Please stay tuned at the end of this video for our required disclosure statement. June 30th marked the final trading session not only of the month, but also the first half of 2017. It was a period marked by strong stock market returns and exceptionally low volatility, although some volatility returned a bit during the last week of June. The markets alternated between gains and losses, with stocks dropping June 27th and 29th, but surging on June 28th. Despite ongoing conflicts in Washington, Wall Street is still in a rally mode. The S&P 500 had its best start since 2013, and the Nasdaq marked the strongest first half of the year since 2009. Stocks have been lifted by the sense that other global economies, particularly in Europe, are starting to stabilize. Not all stocks have risen. The S&P 500 telecommunications sector, which includes phone and internet providers, as well as the energy sector, including oil and gas companies, they're both down. Our economy slowed a little bit less in the first quarter than initially anticipated because of unexpectedly higher consumer spending and a bigger jump in exports. The U.S. gross domestic product, which is the total value of goods produced and services provided in our country during 1 year, increased at 1.4% at an annual rate. It is still, however, the slowest growth rate since the second quarter of 2016. Job growth has been steady, and consumers are feeling better about their ability to pay their bills, take trips, and cover other expenses. Consumer confidence rose in June from May, and experts say conditions are good for economic growth to continue. Americans' personal income soared in June, but that extra cash didn't seem to prompt consumers to spend money. Personal consumption expenditures only gained 0.1% for June, and that's the worst showing since February, a concern. Spending rebounded in March and April after starting the year on a soft note, but the latest reports suggest that consumers are being very frugal once again despite pay increases. What can we expect from the market over the next 6 months? Well, looking into the second half of 2017, analysts believe it is unlikely that low volatility will persist indefinitely. Investors may need to brace for more big swings up and down in the coming months. Wall Street will be focused on whether corporate earnings can continue rising at a healthy pace despite what's going on in Washington and around the globe. What might stall future gains is a market that has become too expensive, political gridlock, a slow-growing economy, and worries about top-performing tech companies cooling off. There is also a feeling that the market's fast start has stolen from gains that might have come later in the year. Interestingly, consumer attitudes hit its lowest level since November of 2016, and economists expect the measure of consumer attitudes to fall even more in the coming months. Consumer attitudes soured in June as U.S. consumer sentiment slid to a 7-month low, though still rising slightly above economic expectations and still holding historical highs in the first half of 2017. Well, that's it for the July update. As always, if you have any concerns or questions about what we've discussed, please give our office a call at 724-940-9060. We'll see you again in August.